Hello, ladies and gentlemen. Happy Wednesday, December 12th, 2018 to you all, and welcome to today's webinar, The Hidden Benefits of Stock Insurance. For those of you who are not familiar with me, my name is Mike Chupka. I'm the Director of Education here at RadioActive Trading and at Power Options at poweropt.com. Well, what a year. Well, almost it has been. We still have, of course, about 19 more days until the end of 2018 and the beginning of 2019. Looking back over the year, it was extremely interesting, wasn't it? Now, we think about how strong the market was, and we think about how good returns started to look beginning of September, right around in here, from where we were at the end of January. But if we look at the chart, SPY, NDX, Dow Jones, and other things, in reality, about 6 out of the 12 months of this year were negative. And as we know, the negative performance always is harder, more pronounced, and can hurt a portfolio more than the bullish moves. Of course, in February, 5th through 9th, we had that sort of volatility crush. We saw another loss in value here. It was about from March 23rd to April 5th. Little hiccup here in July as well that sort of erased the gains we had come back to, about 50% of them. And then we had a nice summer, good summer heading into September. And then October hit like a hard hammer and pretty much erased anything that a bullish trader might have done if they had just bought SPY at the beginning of the year, just decided to hold on, of course, not what we tend to do as options investors. And then they saw another rise, and then, of course, we saw another fall. Well, are we at the bottom now? I don't know. I can't tell. What I do know is I want to be in positions where no matter what happens next, I can't lose more than 5 or 6% on any one position, and I still have the potential for unlimited upside. That's just a broad indicator. NASDAQ and the Dow had different performances, but similar to worse over the last 12 months. During this trading year, I've traded and been in stocks that have gone up over 100%, and even a 5 or 6 months period, not even looking at the last 12 months. I've also had and traded stocks that have dropped 50% in the same time frame, one stock that even dropped over 33% in a 25-day time period. Thankfully, I was in a proper structure where I was long the stock, but I was actually able to profit over 10%, even though the stock was down 33%. Now, the two that come into my mind was GOOS, a Canada Goose company. They make those nice winter jackets. They went from about 30 around February time frame to close to about $72 back a couple of months ago. Penn Gaming moved from over $36 to near $18, a loss of only 50%, and a lot of that was done in just a 1-month time period. We talked to many investors over the year during our Friday sessions, our open discussion, open forums, who've been trading and bouncing in and out of SQ, Square Inc., and Roku. Many others that they saw near 100% gains over that time frame we saw up until June, July, and September, only to give it all back in the last 2 to 3 months. It was kind of hectic. Whether you're a stock trader, whether you're a covered call trader, and whether you're doing straddles or strangles, credit spreads, the ups and downs, half of the year being negative, could really affect a portfolio long term. And in the short term also. So just real quick, I want to know, as we're all here, how was your 2018? Did you have a great year, seeing sort of the best returns you've had in maybe the last 5 years? Did you do pretty good? Hit your target goals for the yearly returns, maybe a little bit more? Did you have a meh year? Break even, maybe a little bit better, a little bit worse? Did you have a not good year? Did you have some gains and then gave them back over the last 2 to 3 months in time? Or did you even have a terrible year, meaning that you're way down, and you erase the gains from previous years. Now, for those of you that might have a question here, I'm only going to launch 2 to 3 polls. The rest of this is going to be basic information, but we're going to do 2 polls right away, then we're going to do another poll later. I'm going to only leave the polls open for about a minute or so. I just want to see, I don't want to take away too much time for what we want to learn today. All right. Okay, so let me go ahead and close the poll. Over 85% of you have voted. That's fantastic. Thank you for your participation, and let me share the results. 38% of you had a meh here. Break even, a little better, a little worse. 54% of you, not good at all. You had some gains, but we gave them back in the last 2 to 3 months. And 8% of you are actually in the terrible situation. You're way down and you erased gains for the past few years. Now, right now, there's still people coming into the room. About 35, 36 of you are in the room right now, but that number keeps going up. No one said that they were doing great or that they were doing good as well. Okay. John posted a comment and says some of the Met people are lying. Okay, so John figures that it was a tough year and not many people maybe did too well or as well as they thought. Well, I'm not going to get in too much into that, John, but I appreciate the comment. Now, let me hide that poll. That's the most important thing. And let's get to this new one. I'm just curious. I just want to know. What strategies did you trade this year? What led to those performances? I should say, my apologies. Were you mostly just trading long stock? Were you doing covered calls or naked puts, sort of kissing cousins, parity trades of one another? Were you looking at spread trades, credit spreads, debit spreads, including calendars? Were you doing long calls or long puts, maybe straddles and strangles as well, involved in that, manipulating straddles or strangles? Or were you doing the sort of more advanced things, iron condors, butterflies, ratio spreads, multi-legged option strategies? Wow, okay, so we're back up to about 80% of the audience already voted. It's only been open for about 50 seconds. I'm going to leave it open for another 10 or 15 minutes. All right, 10 or 15 seconds. Sorry, folks. Fantastic. Okay, this is going to be, oh, still more votes coming in, so I'm just going to leave that open. And of course, you can answer more than one. So we're going to see here the numbers go above 100%. That's no problem. Many of you are doing multiple strategies. I do multiple strategies as well, about 4 or 5 different strategies in my portfolio. All right, let's go ahead and close that. Let me share the results with you. 21% of you are mostly long stock. Whether you're just a long stock trader, you're just getting into options, or perhaps you decided to cut out of options trading maybe in October or so or September and just focus on the long-term holdings. 57% of you doing covered calls, naked puts, probably in management mode for those positions. 36% of you are doing spread trades, credits and debits. Had some ups and downs. If you had the timing right and switched from, let's say, a bull put series to a bear call series when the market turned, you were looking pretty good. But as we know, and we're going to take a look at, one loss on a spread can really come back to hurt you. 14% of you buying calls, buying puts, and doing straddles, and 14% of you are also delving into those multi-leg strategies, iron condors, standard condors, butterflies, and ratio spreads. Fantastic. Well, let's take that into consideration. What complications do we see? Just looking at SPY. I know there's other stocks had other performance, other indexes had other performances as well, but let's just take a look here. What are some of the problems we see that might have caused our issues? Well, it's obvious, isn't it? I mean, we had 50% of the time, we had a negative market. So in a covered call strategy, we're capping the gains, maybe only making 2 or 3% on the better runs that we had. 8, 9, 10% gains on the stock in a 30-day period, you're only making 2%, but you're still on the hook for 97% of a decline. You know, I buy a stock at 50, sell 50 strike call and generate $3, well, I've got myself about a 2%, 3% return, pretty good. But if the stock fell 20%, I'm still down 17. I got a little hedge, but not a lot. Naked puts, very similar. We may get put the stock at the bottom. Hey, that's great if it goes back up. But of course, even with the covered calls and the naked puts, if we start to sell calls lower because we want to roll down to get more premium to hedge our loss, but then the market snaps back, now we've got to pay more money to buy back these calls to get in a higher position. It falls again, we roll down, goes back up, we buy back. We're putting more money in, trying to catch it as it moves up to get more benefit. Now, in a 20-day period, if I sold a call and have, let's say, a 2% return on my covered call position, and the stock moves up 10%, and I want to stay in it, if I roll that call, do I take advantage of that 10% move? No, because I got to buy that back intrinsically. I've got to pay that gain back, now sell a higher call where it could be assigned up here, but I've added that $8, $9, or $10 back in to roll the call. I've only increased the profit by another 2% for what the monthly covered call yield is giving. Spread trades, it's obvious, and it's unfortunate. It got me too. No shame in it. It happens. So, bull put spreads looking great in January as we started the year, and all of a sudden February 5th comes around and boom. I had 3 bull put spreads open that I opened towards the end of January for February expiration about 14, 20 days out. All of those hit near an 80% loss. Well, what does that mean? If I look for a good bull put, 75 to 80% probability of expiring worthless, it means I might be making 50 cents on a 5-point spread, about 11% return, 20 cents on a 2-point spread, and so forth. Well, 3 spreads, down 80% or near a loss of $4, $12 per contract total, what did that do? That technically wiped out 6 months of previous gains, if not more. Now I've got to play catch-up for the next year. Things start looking good, wham, back again. Things look good for 2 to 3 months, little issue, do real good over the summer, and here we are again. Iron condors, butterflies, same issue without the management. Of course, I manage these positions, and thankfully, it only represents about 15% of my portfolio, and I like to use VIX calls there, which turned a real good profit in February that countered the loss there as well. But that's where we are. That's why we have 38% of you having a meh year, 54% not good, and 8% were in the terrible range. It's because of the structures of the trades we were using. 57% using covered calls, 36% using spread trades. That's what happens to those strategies in this type of trading year. Of course, there is an answer. Here's GOOS. Here's one of the ones that I mentioned. And we see here we have low prices at the beginning of the year in the $35 to $36 range right around May 1st. We have that sudden fantastic surprise earnings and the stock almost doubles. It does double actually. We go up to about $66. Some retracement, that's good. It comes back. We're back down to $50. So from about $66, $68 back down to $50, we gave up about half of the gains that we've seen. And we stay in it, it goes back up, and then here, we're back to just a small profit, $8, $9, still pretty good, and nowhere near where we were. Then we get back up to this range, and now we're right back down to that $55 level. Hard to manipulate with spread trading. Straddles, maybe if you got the timing right, bought in, sold, roll your calls and your puts, could have done extraordinarily well with this type of strategy, or this type of stock, excuse me. But just doing one strategy, covered calls, been going good, making my 2 to 3%, missed the upside, decide to stay in, roll up and add to the cost basis, and now we're down. So now I try to hedge that, sell a 55 call, now I've got to buy it back. Okay, this looks good, and then maybe I roll up here to a higher strike. That's good, let it expire, but I need a hedge. I sell here, and oops, now I've got to buy it back, and then here we are again. I'm sort of following that freight train, trying to stand in the way of it and hope that it just expires, and then still getting trapped. So we know the structures we're using. Even those of you in long stock, fortunately, you might have used a stop order at some point or a trailing stop. You get up here, you set a trailing stop, and you're out. You miss a little bit more gains, but you don't have to suffer through this loss. Or you get in here and you set a trailing stop and you're out, You missed this up here unless you bought back in, but looking at the chart, you probably decided this was not something that looked long-term to continue to hold. That's the issue, isn't it? We get stopped out too much when we don't want to, or we cap our gains with the strategies that we're using. Now, what about a different structure? Before that 50% gain, now you can see this actually in the Fusion track record, but back on May 1st, 2018, I did enter GOOS. For the Fusion subscribers at RadioActive Trading, posted my actual trade, bought stock at 36.18, and at the same time, I bought a December 40 strike put for 6.85. That may sound opposite of what you're used to for stock insurance. Why would I add 6.85 to a stock trading at 36 where my break even is at 43.03? Now, my true risk is only 3.03. I'm guaranteed to get 40 back no matter what the stock does. So I'm only risking 7% on this position when I open it. And what is the benefit of this simple structure? It's not so simple. It's just a married put. You're probably familiar with that. But on May 1st, I'm buying a December 40 put. I'm not buying a June put. I'm not buying a May put. I'm buying a December put that's farther out in time and slightly in the money to control risk to single digits. What do I get from this? I get a controlled risk position. I have unlimited upside profit potential if the stock continues to move up. Sure, the put's going to decline. We're going to talk about that in a moment. I also have a lower cost of insurance. I have the ability to manipulate that second asset. That's one of the hidden benefits of stock insurance done in the proper structure. It's not something that's out of the money at a cheap price that I'm hoping just expires because I wanted that in the case of what if. And I don't want to buy it month by month by month. I have a second working asset that is far out in time. I have no fear at earnings. I have no fear at a black swan event. I have a guaranteed exit at 40, unlike a stop order set at 35 or 33, where if the stock fell 33%, I get out for whatever the market can give me as the stop order is triggered. I have a guaranteed exit at 40, and it forces me into an ideal size trade by buying the stock and buying the put to control risk to single digits, not only on my investment, but in my portfolio as well. Now, the first two benefits are obvious. Okay, we have that controlled risk, and we have unlimited upside. But how can I sit here and claim to you, experienced traders and options investors, all of you mostly were doing some kind of options or some kind of stock trading, how could I claim to you that a December 40 strike put on a stock trading at 36 is a lower cost of insurance? Some of you are thinking that's a flat-out lie. You could have bought a May 35 or a May 30 put for 30 cents or $1. That's lower cost of insurance. Well, let's look at the 40 puts on GOOS from May 1st. Using the historical tools on power options. Standard May series, May 18th, May 25th, were priced at $3.60 to $3.90. And the time value there is about $1.09 to $1.90. And the midpoint time value, is only 25 cents really, and 50 cents, 25 to 50 cents. Okay? But let's say we wanted to go standard. I wanted to go out 1 month. I don't want to go out 2 weeks. I want to go out 1 month. I want to go out to June. Standard expiration, June 15th. Ask price is at $4.70. The time value is roughly $4.08. At the midpoint, it's a better view. It's $3.53. Now our ask price here on the January is $7.70, and that's 262 days out in time. So I could buy the 40 put for $4.70, some intrinsic value, some time value, or the January 40, 262 days out for $7.70, $3 more. That's expensive. That's not a lower cost of insurance. But think about it this way. The June is 45 days out in time. The January is 262 days out, about 6 times the amount of time. It comes out to be 5.8% actually. June 40 we saw was an ask at 470. The time value was about 130 for 45 days. The January 40 was 770. It's less than double. The time value of that further out put is only 425. A little bit more than 3 times the cost, not 6 times the cost. Many of you are already familiar with this. Those of you doing covered calls and naked puts, 36% of you doing spread trades and the 14% of you doing iron condors, even the 14% of you buying calls and buying puts, what do you know? You enter a covered call today, are you going to buy a stock and sell it January, slightly out of the money? Maybe, if that's your plan, but what do you know? You know that you get a better annualized return if you sell month by month by month. The option that's 6 times the amount of time out in time is not 6 times the cost. Doing spread trades, I don't want to do a bull put credit spread that's 6 to 8 months out in time. Might do a bull call debit spread that way, but I'm not going to do a bull put credit or a bear call credit. I'm going to do a bull put or a bear call that's 14, 30, less than 45 days out in time because my annualized return is going to be higher. But when you're buying a call, buying a put for insurance against your position, buying a call against your short stock for insurance against your short stock position, you want to be going 3, 4, 5 months out in time to give the stock more time to move in your desired direction. And because you get a lower cost per day. You've got the same guaranteed exit. And you get the lower cost per day. Is it really worth it to buy insurance that looks so expensive, slightly in the money, farther out in time? Well, on June 15th, after that surprise earnings, GOOS was trading at 6102. That June 45 put expires. Okay. But if you decide to stay in the position, we've got this jump up in price here. We're at 6102. That June 45 put that we bought expires worthless. Lose the small premium we paid into it. Okay. Or I'm sorry, the June 40 expires. It's the 40 expires. It was 45 days out. But I want to stay in. So now I've got to buy a July or an August put, which would have been a good idea in this situation after you've got the gains up there. Maybe even go to a 50 or a 55 put in that case. But you lose the value here. You pay in another cost here, maybe another $3, maybe another $4 on the position. Now you've got a total of about $8 of insurance. Maybe by September, you've got $8 of insurance. I'm still holding the January 40 put that I only paid $7.70 for. I have a lower annualized cost by going far term. In addition to that, what else do we know? Those of you buying long calls and buying long puts, when you buy something that's 3 or 4 months out in time, when you see a sudden move one direction in the first 20 to 30 days, you still have 60 days of time premium remaining. Even though that January 40 put is now deep out of the money, with the stock trading at 61 and going a little bit higher, but on June 15th, that's still worth $1.70. Did I lose $6 on that potential put where we saw it priced at $7.70? Yes, I did. But the stock is up about $25 from where I bought it. I'll make that trade-off any day. I'm okay losing $6 on an insurance policy that guaranteed, if it went the other way and dropped down to $15 per share, the worst I could do was a 7% loss, guaranteed. And if there's still time value remaining, that's going to be less than a 7% loss because I get the intrinsic plus the time. But what can I do now, sitting at June 15th? I've got a January put. I've got a stock that's up about 50%, and the January put did not go to zero. I can manipulate that, can't I? I can take advantage of the time value that still remains to get a different put at a lower cost. Now, this extreme situation. Of course, I know what we all would have done in this situation if we had entered that stock on May 1st at $36, bought any type of put, maybe even sold a covered call. Well, with that surprise earnings gap up, you would have likely closed the position, we would have taken our profits, and we would have moved on. But think about this. We bought stock at $36.18. Our initial January 40 put would have been around $7.70. After that gap, great earnings surprise, I can sell the put for $1.70. What happened to the rest of the puts in January? They all came down in price as well. I can now buy a January 50 put on June 15th for about $4. There's a bid of $3.80 and an ask of about $4.20. So it would cost about $4 to get a January 50 put. What does that mean? What did I put into this position? I bought stock at $36.18. I bought that initial put at $7.70, and I'm going to buy a new 50 strike put, 10 points higher for $4 with the stock at 60. Total into this position is $47.88, 11 points higher than when I purchased it. But I sold to close that January 40 put, still had some value in it. So we drop our cost basis $1.70 down to $46.18. That's total. Both puts. The stock price itself. Small premium, $1.70, about equal to a covered call at the money that you might get in normal volatility situations. A little bit higher than normal volatility, actually, on a $50 stock, $60 stock, but $170 is about at the money. It's pretty decent. So here we are total at $46.18, but what did I do? I moved up to a January 50 put. On June 15th, it's still 7 months out in time. But I have a cost basis only $46.18 with a guaranteed exit of 50. I have a guaranteed profit of $382 or 8.3%. It's what we call a bulletproof position. That is the worst case scenario. That's if I held it all the way to January, did nothing, and the stock was below 50, I'd only make 8.3%. But I've got a put that's 7 months out in time, from June 15th to January, a guaranteed profit of 8.3% even if the stock falls to $1 per share. But what else can I do? Going through the cycle of ups and downs, I can still manipulate that put option. I can roll it up again, or I can roll it down as the market moves. I can get a higher guaranteed exit. Well, I own stock and I own a put. I can sell monthly covered calls against this 7 month out protected stock structure and have no risk to the downside. Unlike entering a covered call, getting 3%, seeing the stock fall 15%, now you're at a 12% loss still and you've got to manage it. I sell a call, get 3% premium. I now have a guaranteed profit of 11.3%, but I do still have a capped upside. I'm not going to hide that. Still capped upside. But again, I can continue to manipulate this and just increase this guaranteed profit. Or I can do spread trades inside that nested spread, which don't take on the risk of a standard credit spread or a ratio spread. Now, how about that? Do you think that would appeal to you, having a position that has no risk at all, still being able to manipulate it and generate income as you're doing now with other option strategies? But think about it this way. What if you had kept all of your losses limited over the last year to only 7% or less? That initial structure I showed, if I did nothing between now and January and the stock was trading below 40, worst I could have done was a 7% loss. Now, by the way, I can still collect dividends during that entire time as well. Owning the put against your stock does not negate the benefit of stock ownership. So we can collect dividends. I can still do other things, but not even considering the fact that at one point this position could have had a guaranteed profit of 8.3% going forward for another 7 months and could still be manipulated with the same strategies you're likely using right now, but with no risk. I had a conversation yesterday, coaching session actually here at Power Options, a customer of ours. He had a stock, of course, that's bulletproof, but he's just doing covered calls. Well, how is that possible? Well, it can be done over time. Turns out he bought a stock at $5 several years ago. It's now trading at 20. It was back in 2014. So over 4 years, he generated enough premium to have no risk on the trade, making 40 cents, 50 cents here on that lower price stock position. In any case, he's sitting on a bulletproof position, but it took him 3 years to do it. This is a bulletproof position in 30 to 40 days. Is the extra cost worth it? Absolutely. All right, so I've had that poll open for about 1:40. Let me go ahead and close the poll, share the results. All right, 25% of you said that you would be ahead a lot more if you'd kept all your losses to less than 7% and still had, of course, the ability to have the upside profits that you made, either in covered calls or even just buying stock directly. 25% said it would have taken your meh year to a winning year. 38% say you would have gained instead of lost. 13% of you said you would have been down, but you would have been down a lot less. What does that tell us? That tells us that even with the view of this expensive put, it looks like I was adding almost $7 or $7.70 in the case of the January put option to the cost basis of the stock, it still would have performed better than what you were doing in the last 12 months. We still have 19 days to see if we can get to profit, of course, but again, where do we want to be next year going forward? Where do we want to see ourselves within the next 12 months, not knowing the potential of what could happen with rate hikes, maybe, maybe not. Change in the House, is that going to affect our markets? Trade wars further, more tariffs, less tariffs? Who knows? All right. But let's take a consideration here. We looked at an expensive 40 put in the money at a stock trading at 36. Why buy that put? Why not take that lower strike for the lower cost? On May 1st, same time we looked at that original structure, the June 15th expiration, 45 days out, 30 put was only 50 cents. But think about it. If I buy a 30 put, in order for that insurance policy to work, the stock had to fall $6.18 for that to kick in. We had to fall from 36.18 down to 30 for that insurance policy to start working for us. Now we paid 50 cents for it, pretty cheap. So that's a total risk of $6.68. Now we're into 15% loss range of our investment, double the risk of the in-the-money put. Now true, in this case, GOOS gapped up to 60, so you would have only had a cost basis of 36.88 and would have made more money. Probably just would have liquidated when the stock hit 61 or 62. Believe me, I know. I understand that. But if it had gone the other way and it had dropped to 20, and now we're taking a 15 to 20% risk of what you invested. And that's only for 45 days of protection. Is that a problem? Absolutely. We think about something called the martingale. Now, if you have a 10% loss on a position, do you need a 10% gain to get back to break even? No, you need closer to an 11% gain. Well, that's not too bad, but how many 11% gains did you have this year that you actually kept? If you take a 25% loss on a position, an unexpected earnings event, pre-earnings warning announcement before earnings even come out, maybe you had a stop order in at 7%, that blows right through it in the aftermarket, you get filled at 25%, you now need a 33% gain to get back to break even. And if you suffer a 33% loss, which some of us may have seen percentage-wise on our spread trades, our condors, we need a 50% gain on what we have left to get back where we started. That's the lie of leverage, what's called the martingale and gambler's ruin. But if I take a 5% loss, I only need a 5.2% gain to get back to break even, which is much more realistic. So the improper structure of just buying a 1 month out out of the money put, which takes on a 15 to 20% risk, can get you into trouble much faster than you think, even though you have an insurance policy in place. That is not the proper structure. Oh, just talk about other alternatives. What about a standard collar? Many of you doing covered calls probably went into this at some point or another. When the market started to turn, you had fear of the market. On May 1st with GOOS, I might have sold the out-of-the-money 40 call and bought that June 30 put. So I have a nice little bracketed profit and loss chart there. What happens? I missed the upside, and you still had a 7% risk, but only for 45 days. If you take that 7% loss, now you've got to either manage this stock or just move away from it and do other positions. My structure still has me protected out 7 more months. And I've seen this other structure. It's called a reverse collar by some, and it's called a different name by others. But why don't I pay for the insurance by doing the opposite? Instead of buying this far out put that looks expensive, why don't I sell a January 40 call far out in time and buy a short-term July 35 put? So now I'm getting maybe $3 for that call, and I'm only paying $1 for this put, so I'm getting $2 of premium. So I have a no-risk position, right? Wrong. Because you did pay for the insurance. And you can say, well, my cost basis, if I got $2 of premium, dropped down to $34.18, I've got a 35 put. But come June, what happens? The put's at 0, and you have to buy a new one to stay in it. But the call didn't go to 0. That 40 call is in the money, and it still has 7 months of time premium. You did the opposite of what we talked about earlier. To maximize annualized return, you want to be selling premium month by month, or every 14 days or 20 days, and you want to buy further out in time for the lower cost per day. This has you selling into a lower annualized return and buying into a higher annualized cost. And it has to be adjusted in that first 20 to 30 days, 45 days, in order to stay in the position, because this is not going to drop to 0, even if the stock stayed at 36 come July expiration or June expiration. That 2019 January 40 call is still going to have $2, $2.50 a time premium. What does that mean? Well, in order to get out of the position, that $2 premium you generated is going to be given back to buy to close this call if you're looking to liquidate the position and the stock hasn't moved. You're at a loss. You're not at a gain. That's not how it works. That structure works against you over time, in my opinion. I'll have more of that for you later as we continue our journey this month into the benefits of radioactive trading and hidden stock insurance as well. So this proper structure that I showed you with GOOS, it puts time on your side. It leaves the upside open to begin with, but I can choose to do various adjustments against it, just as you're doing right now, but having a guaranteed single-digit risk, not the assumed insurance of a stop order. I, of course, have peace of mind. I don't really have peace of mind with a stop order on a covered call position, a naked put, or even a contingent order on a spread trade. I've got a guaranteed exit. But because I properly structured it, went further out in time, control the risk to single digits, I am now allowed to manipulate that second asset to better control risk and potentially cancel all of the risk on the trade. And I still have time on my side for the stock to continue to move in the direction I want, or to continue to manipulate it or milk that protected structure to generate more income with other adjustments you're doing in your portfolio right now, with no fear of risk and actually continuing to lower the risk long term or even short term. And I'd hinted at this before. Maybe this is a cheat. I'm sharing with you a stock that gained 50% or so due to an unexpected earnings. Yeah, we saw some of those. We've all traded through those in the past 12 months, and we've probably given those back a lot, given a lot of those profits back. What about the current market? What about a stock that has not moved or declined even in the past few weeks? Well, let's take a look at a recent RadioActive trade that we opened for our Fusion subscribers about 20 days ago. On November 20th, 2018, right before last little hiccup that we had in December, Starbucks was trading at 67.22. So I went ahead and bought shares of stock at 67.22, and I purchased a January 70 put at 7.90. Here we are again, adding almost 12% of the underlying stock into the cost basis of this structure. Now this put is 423 days out in time. Total invested with a stock in the put is 75.12. Does that mean that's my break even? I'll get to that in a moment. Remember, I'm guaranteed to get $70 back. Starbucks can fall to $20 per share over the next 30 days, 60 days, or 90 days, and I can't lose more than $5.12 per share, or 6.8% of what I invested into this position. It's not a 30-day put. It's not a cheap December 60 put, which would still take on a 15 to 20% risk because the insurance doesn't kick in until I get to $60 per share. Here is a structure where I'm out 420 some odd days, and I can't lose more than 6.8% in the absolute worst case scenario. We saw the cost basis there of about 75.12, right? So the max risk was $5.12. Is 75.12 my break even? Yes, if and only if I hold the position all the way to January 2020 expiration. Make no adjustments, sell no premium, do no manipulation of my second asset that is working in my favor, and accept no dividends. I would need the stock to be trading at 75.12 in 423 days to make a dime. Well, here we are today. The stock's down a little bit, down about $1. Stock's trading at 66.43. It's down about 80 cents. My put is at 8.15. All right, it doesn't go to zero when I buy the put. In fact, when I purchased that 2020 70 strike put for 7.90, I could have gone back in the market a minute later and sold that put for about 7.80 or 7.85. All I'm risking when I first open this structure is the bid-ask spread. I'm not down 7.90. I'm not 7.90 behind the 8 ball. I'm not even down 5.12. The true risk or the time value that I paid into this position. All I'm risking at first is the bid-ask spread. Am I losing right now? Yeah. The stock's down 80 cents. I've got a gain of about 25 cents on my put from 7.90 to 8.15. Stock's down from 77.22 or so down to 66.43. So down 80 on the stock, up 25 on the put. Total loss right now, if I liquidate, is under 1%. And think about this. When I open the stock at 67.22, that December 30-day out 65 put was 105. It's now effectively the same price. Time value is decaying rapidly. There's some implied volatility still out there. But in the next 5 to 10 days, if the stock stays above 65, this is going to go to zero. I'm still going to be looking at break even or a little bit better on my put, even if the stock stays at the same price that we are now, heading through to December expiration next week. This will drop to zero. I'll lose all that 105. This is still a little bit above right now, and even if the stock goes back to where it was, this might drop down to 780, 770. I'm only losing 10 to 20 cents of what I paid into that put. So that's where we are now. But if I'm worried about the market, I'm worried about what might happen in the next 10 to 15 days before the end of 2018, coming up in about 19 days, even though my stock hasn't moved. Even though I'm seeing a loss on the stock and a very small subtle gain on the put, is there any benefit to this extra cost long-term put? Remember, we paid $5.12 into the time value, 6.8%. I still have $4.35 of time value. Why is that down 80 cents when the puts gained 20? No, it gained a little bit of intrinsic value, didn't it? The time value still decayed a little, but I gained some intrinsic. But we still have 435 of time value and 401 days of insurance in place. Cost is already in. That $790 I paid for the put is already factored in to that $75.12 cost basis. I had the proper structure to start. I'm worried about the market. I want to cut my risk in half. Could I sell a call right now? Sure. But if the stock recovers and the market recovers, now I've got a capped upside. Can I cut the risk in half? Yes, I can. Remember, my total invested in Starbucks was $75.12. That's the combination of the stock and the cost basis of the put from the November 20th trade entry. What I could do right now is sell to close that January 70 put at $8.15. A gain of only 20 cents. The stock is down. But I can move it in closer, can't I? I can sell to close that put for $8.15 and buy to open the April 70 for $5.45. I get a credit of $2.70. I was in the proper structure to begin with. Now I'm second guessing myself, or maybe I think the market's weaker than I thought. I still have good protection in place. I can cut it in half. I can move that put in closer in time, reduce my cost basis by $2.70. Now my new cost into the position, $75.12, get $8.15 back, so it puts us down about 67. Add $5.45, it puts us at a cost basis of $72.42 total into the position. And I still have a guaranteed exit for the next 5 months at $70. So my new risk is only $2.42 or 3.3%. Earnings are coming out, I believe, at the end of January. Worst I can do is 3.3%. I still have another 30 days before earnings, 25 days to the next January expiration. I'm sorry, it's about 40 days to the next January expiration, 60 days to the earnings. I could generate premium and lower this to maybe only 1% or less, depending on the market conditions. I could move the put in closer and almost cancel all of the risk with earnings coming up in the next 40 days because I started with the proper structure to begin with. I didn't buy a cheap December put. I didn't buy a 1 month out put and increase my annualized cost basis. I set myself up with a proper structure first that can be manipulated, that second asset, to lower my risk. Here's the math. 100 shares of Starbucks, $67.22, purchased on November 20th. Add in the cost of that original 2020 January 70 put at $7.90. We saw that. That put our original cost basis at $75.12. We're going to get about $8.15 back for selling that January 2020 put that we own. We gain only about 25 cents. But then we add another $5.45 into the position, but keep that 70 strike guaranteed exit. We reduce our cost basis to $72.42 total. Now we only have a risk of 3.3%, and I still have 5 months to go. I'm going to cross at least one earnings, possibly two, but I think it's only one. But I'm going to cross one earnings on Starbucks with a risk drop from 6.8% to 3.3%. And I still have time to adjust that risk, lower that risk further before the potential earnings announcement as well. I still have unlimited upside for 5 months. By the way, is my break-even $72.42? Only at April expiration. This still has 5 months of time premium. The break-even now is right at about $70 per share. I don't need it to go to $72.42. If it moves back up to $68 or $69 in the next 2 weeks, I'm going to be at a profit. Maybe not the profit from my target goals, but I'm still going to be at a profit. And then I can still manipulate the position better because there'll be better premiums to sell. And I can sell premium and leave the upside open with a different adjustment also. And manipulate the put too, depending on what the market does, because I still have time on my side and in my favor. This is really the hidden benefits of the proper stock insurance. The 1 month out OTM puts, December 65 or 60 strike, are now at 0. You could have bought them cheaply for 50 cents, 80 cents, $1 on November 20th when I entered this trade, but now they're 0. You've lost that whole time value you've paid into the position, and you're still carrying a risk of 15, 20% using the 60 put, maybe 7, 8, 9% using the 65. The 70 strike December is just an intrinsic, and you lost all the time value you've paid into the position. I lost some time value, gained some intrinsic, got a little 20 cent, 25 cent gain on my put that was far out in time and looked really expensive, but because I did the proper structure first, I can manipulate it without losing money and put myself in a position to lower risk, cut the risk in half if I fear market weakness, if I know I have earnings coming up and don't want to take the chance of a 20% drop where I might lose all of that 6.5% as well. It's not just insurance. It's not just a fear factor for 30 days and saying, I'm just going to go ahead and buy this put, and if it falls, I'll take my 12% loss and move on. It's a second asset when structured properly that can be manipulated to continue to adjust the position, lower the overall risk of the total structure, still leave the upside open, and still have the benefit to do more. What you just saw were some of the hidden benefits of the properly structured stock insurance. You just saw, technically, 2 of the 12 quote-unquote income methods that we use in the radioactive trading technique to lower the risk, generate income, potentially bulletproof the trade where you have no risk, as we saw in the GOOS example. And still have the potential for unlimited upside. But what are the other 10? Okay, and this is a question that Wayne asks. Wayne asks, would you have insurance on all the time or just when you thought the stock would go down? All the time. Okay, so rather than, if I fear the market's going to fall, buy a put then, let it fall, and then hope I time it right, Wayne, and then sell to close that put, and then adjust it up, or sell a call, and then the stock starts to move up, and then I buy another put where I think I've timed the high, and then it falls again, so I take the profit from that put? No. I'm going to have that insurance in all the time. Why do I consider, instead of trying to find the timing, Wayne? I'm going to come back to this slide in a second. But why would I continue to have the insurance in place all the time, where I can manipulate it if it moves up or if it moves down? I'll take a look at it then. But why not just try to time things and do it that way? Well, think about the chart we showed earlier and the brief discussion we had about what happens in the down market. It happens faster than we consider. So I think I'm going to try to time the bottom here and time the bottom here. Maybe I thought this was the bottom and then it continued to move further. And then it moves back up. So I think this is the top here, and I buy a put and do this, and then I do that, and then I do that. Well, that's great in theory. Wayne, I agree with you. And if your timing's that good, there's probably not much I can help you with in the market. But if your timing's that good, you wouldn't have been one of the 38% that said, man, you had a break-even year, 54% that said you had some gains but gave them all back and it wasn't a good year, or the 8% that said it was a terrible year. So having the put in place the whole time means even I can sit here and just relax. I don't have to feel forced to manage the position. I don't have to feel forced. I don't feel forced to try to roll down a covered call with each step because I'm seeing 8%, 6% losses. I'm trying to gain 2% back to hedge that loss, and then it rebounds and I'm trapped. I'm caught with the lower strike, and I've got to roll that up now. I can wait on the put, and even if I miss the bottom and it comes back up, guess what? This is still more profitable here than it was here. So I'll adjust the put, but I'll leave it in place because what if it continues down? What if it keeps moving down and declining? Sort of what my pen position did, which we'll talk about later as well. in the next couple of days and so forth. But I always have the put in place, Wayne, and I adjust it with keeping a new put in place. I personally never, in this technique, this portion of my portfolio, it's about 50 to 55% of my total portfolio, I use this strategy, radioactive trading techniques. Me personally, I will never not have the put in place. I will always have that put in place. Ernie does sometimes take it off, okay? And that's what happens in that nature as well. But I don't. I always leave the put in place, and I roll the put with the structure long term. Okay? All right, so let me just put that up there. I want to get back to where we were. All right, so we talked about what are the other 10. Well, in the proper structure, owning the stock, protected by a put, I can still sell calls without the assumed insurance of a stop order. It's like a collar. But I've got a guaranteed exit at the bottom that's 6, 7, 8 months out in time, and I'm selling a call that's 15, 20 to 30 days out in time to help lower the cost as well. Wayne followed up and said, could you talk about how spread trades have no risk? Well, we're talking about in the proper structure. Think about this way. Let's just take Starbucks. Trading at 66, Wayne, you know, I showed it, we were in at 67. Okay. Now, if I'm bearish on the market, I could maybe sell a 67.5 December call, right? 67.5, and I could buy a 70. That would be a bear call spread, and I might get 30 cents for it for the next 14, I'm sorry, you know, roughly about 8 days, 10 days. Okay, so let's say 30 cents or so for a risk of 220, a 7 or 8 to 1 risk-reward ratio, common with what you'd expect, perhaps with an 80% probability. So there's my bear call spread. What do I have to do? I've got to put up the margin requirement to enter that position. Stock stays below 67.5, we make a profit. Goes above 67.80, we have a loss. And the max loss is 7 to 1. Proper structure, I own a stock and I own a put. Let's do it down here. I'm sorry. I own a stock and I own a put. I sell the 67.5 call. What is that? Well, in the proper structure, it's just a covered call, isn't it? I don't have to put up any margin because I already own the stock, 67.43, even though it's at 66. I own the put here at 70. I sell this call. Well, that would just sort of be a standard collar, but it would be a time collar. That would look like this, with just the 67.5 call. But in the proper structure, now I buy the 70. What do I get? I'm going to get something that looks like this. I get the premium. I can still have a profit at the peak. I have a little heartbeat here. And if the stock continues to move up, I still have infinite upside. Why? Let's say Starbucks goes to 80. I may be obligated to deliver my shares of stock at 67.50, but I have the right to buy shares of stock at 70. This is essentially a 70 call that I received at a 30-cent net credit. So it leaves the upside open. I still reduce the risk by a small amount of 30 cents. Probably wouldn't do that because it wouldn't match my goals for that adjustment. But that's one of several spread trades that we use. Credit spreads, condors, butterflies even, broken wing butterflies, that can be done in the proper structure and not add risk. You can still generate the credit and lower risk. Even ratio spreads won't give you the infinite risk to the upside, done in the proper structure of the married put. And of course, there's other ways that I can manipulate that second asset other than we showed today. If the stock falls, stagnates, moves up a lot, moves up a little, I can still adjust that put different ways than we showed to lower the break-even and the cost basis and to set up a structure that can profit in any direction with little to no risk. Already set in place. But that's why we take this proper structure on in the first place, is to have that advantage. So you have to take into account that with that proper structure, you can do those as well. But not every spread that you're used to will be used as the 12 techniques. Believe me, some of them will still add risk, and I wouldn't necessarily do those. All right. Is it Michael? I'm sorry. Michael posed another question for us today. Mike, I'm sorry, Mike. How do you determine the time the put should be in place when you purchase the stock? Mike, I do it right away. I don't try to time the trades. As I showed when we went back to that stock price, I could have bought GOOS at 36, assuming the stock would go up, which it did, and then, yeah, if I waited for the stock to jump up to 60, I could have bought the put at that time, and I'd been looking fantastic. What if I was wrong? Think about this. We showed Starbucks being bought on November 20th, 67.22, and I bought the January 70 put at the same instant because it had the exact risk I wanted. Under 7.5%, I'm taking a 6.8% risk for 423 days. It is a bullish strategy. Don't get me wrong, Mike. I am expecting the stock to move up, but the stock fell. What if I had opened on Starbucks on November 20th, didn't buy the put? On December 7th or on December 10th, stock was down about $64. I buy the 70 put now, it's going to cost me $9. I buy the 67.5, it's going to cost me about the $7.90 I paid for the 70 put at the open on November 20th, right? But that's at 67.5. My risk is going to be $2.50 higher, almost 10 points. I'm sorry, almost 760, 780, over 10%. So when I find a stock that I want, for what I'm looking for in this trading structure, in this portion of my portfolio, I add the put right away. I don't try to time it because in order to try to time the purchase of the put or buying the put first, hoping the stock could go down and then buy the stock more cheaply, if you're wrong, you get trapped. And we get in that same problem we've had with the covered call structure, the naked put structure, the spread trade structure. What I thought was going to happen didn't happen. I'm going to set up the stock and put together, Mike, at the same time to enter a position that has unlimited upside and has the controlled risk in place immediately rather than try to time the trade, hope that I'm right, but in the case that I'm wrong, I've now put myself in a much worse situation than I would have been from the start. If Starbucks fell to 65, was trading at 65 right now, I could manipulate that 70 put, I could close it down, I could buy an April, I could buy an April lower strike, I could buy a January 2019 lower strike and still lower the potential risk. If I had just bought Starbucks at 67.22 and today the stock was down at 65, any put I buy is going to lock in the loss that I had on the position and add the risk of the time value I have to pay. I'm going to set up that structure at the same time as well. John makes a comment on the pen position. He says, hope you do a webinar on how the pen trade was profitable. Yeah, the pen position, got into it on October 2nd. I closed it, I think, on October 30th, maybe October 28th. I'm not sure when I actually closed pen. Anyway, I bought pen at about 32. I closed it when the stock was trading at about 26, 25, I think. Maybe even 24. In any case, it dropped a lot over a 28-day period. Using this structure and one of the adjustments here that allows me to profit in either direction, I was long stock that entire 30 days, wrote it down to 24, but I took a 10% profit on a stock that was down 33% from where I opened it. We might discuss that on our journey. We probably will discuss that on our journey over the next week or two, John. I promise you that. We'll show you what happened with Penn. And there's other stocks too that I had. Another stock this year, PHM, was down 33%, I believe, over a 2-month period, and I only took a loss of 1.8%. Not as attractive as Penn, but that's the power of controlling risk up front. Having the limited risk structure in play first, then not trying to time it by saying, okay, I have the stock, let me buy the put, or I bought the put, let me wait for it to go down and buy the stock cheaply. Having it structured first so that in any scenario, you have a greater benefit and the hidden benefits of stock insurance above what we see with the standard covered call, the naked put, spread trade positions, and more. In the email I sent last night, I promised to take you on a journey over the next few weeks and show you how this approach can benefit your trading. We've covered a lot of it already today. Think about your answers to the previous polls, and especially that last poll. What if you had just kept all of your losses to 7% or less, without considering manipulation, without considering adjustments or selling premium, how would that have changed your year? 25% said you'd be ahead by a lot more. 25% it would have taken that mad break-even year to a winning year. 38% of you would have gained instead of lost, and even 13% said they might still be down, but you're going to be down a lot less. That's just considering the initial structure and the hidden benefits of stock insurance. Actually, it's just considering the original structure. Those hidden benefits that come into play could put you in positions where you're losing only 3%, as we showed the potential with Starbucks. Maybe having no risk, as we showed with the potential example of GOOS after that large earnings gap. Without putting more money in month by month by month to control it. It looks cheaper, but what do we know about any insurance policy? You pay month by month, you're paying a higher annualized premium. If your insurance company allows you to pay 6 months at a time or a year at a time, you're getting a discount. The options premiums work the same way. I get a lower cost per day with the proper structure, going further out in time and controlling the risk to 5, 6, or 7%, as opposed to trying to buy a cheap $1 or 80 cent put below the current stock price month by month by month. So, with that going forward, and John's comment about showing the pen example, yes, I promise to take you on a journey. We showed you a lot today. We showed you how it would benefit you, and most of you, 100% of you, said that it would have benefited you just by doing that basic structure. But there is more to come. And I'm not even going to waste your time by pitching you on buying anything today. So what is next? I'm going to send you an email when the recording is posted. Probably be done around 4 or 5 o'clock Eastern time this afternoon. I'm going to send you other insights over the next couple of days. And I'm going to invite you to Tuesday's webinar. You can go to RadioActiveTrading.com. You'll be able to see the next webinar coming up here for Tuesday. Let's make a proper protected stock trade. I'm going to go a little bit deeper into the selection process, what I look for, what put I would buy, and we're going to post a new trade for our Fusion subscribers as well. And during the next few days leading up to Tuesday's webinar, I'm going to spend you a special offer in addition to the free information that's going to be coming up as well. So hopefully that sounds fair. You sat with me for a full hour and 10 minutes. I'm not going to give you any pitch. I'm going to send you an email so you can review this recording. I'm going to give you maybe something else on Thursday, a little bit more insight into some of the things we talked about today. And then on Tuesday, I'm going to walk you through my process of what I select for a radioactive trade, what I look for in the put, why I wouldn't use other puts. We're going to post a trade for our Fusion subscribers. And before Tuesday, well before Tuesday, you're also going to see a special offer and how you can get this education with a lot of bonuses and a lot of benefits beyond the hidden benefits we already talked about today and how it would have helped your portfolio. Of course, this doesn't mean I'm going to disappear for the next 3 to 4 days until Tuesday. If you do have questions, email me at any time to support@radioactivetrading.com. Feel free to call us here during market hours at 302-992-7971 as well. I'll be more than happy to take your questions. I personally am not going to be available for the next 45 minutes or so, 35 minutes, so just keep that in mind. But you can call me anytime during market hours or send me an email at any time. And keep an eye out for those emails you're going to get with the recording, other information, invites to Tuesday's webinar, and much more between now and Tuesday before our next presentation. Ladies and gentlemen, thank you very much for joining me today. Thank you for your questions. Thank you for your interest. I hope to see you sometime soon, and I hope to see your comments and your questions via email or posted onto the webinar when it's posted as well. Take care, everyone. Hey, happy trading as best as we can expect through the rest of December. See what's happening with this market. Looks like a good day today for those of you that are doing the bullish trades, but we'll see. We've still got 19 days to go for things to go amiss. I don't want to see it go amiss. I want to see you protect your positions. I want to see you turn a losing year into a winning year, or turn a meh year into a winning year going forward, so we don't have the same issues in 2019 that we might have experienced in 2018. Take care, everyone. Good night.